Managing to Manage webinar. My name is Rachel Yanchis, and I'm a Vertical Marketing Specialist at Viventium. We're excited to have our Senior Manager of Research and Development, Yonina Shineweather, CPA, and our Product Engineer, Mia Saric, FPC, this afternoon as we learn how to ensure compliance in the real estate and property management industry. Before I hand this over to Yonina, I want you to know that we value your feedback from this webinar, and we look forward to sharing with you more insights that will help you grow your business successfully. If you have any questions throughout the webinar, please feel free to use your question feature on your toolbar to type them in so our presenters can address them at the end if there's time. For more information on our unique offering for your industry, please check out www.viventium.com/industries-real-estate. Yonina, we're looking forward to this session, and I'll hand it over to you to get started.
Thank you so much, Rachel, and welcome everyone to this afternoon's webinar, Managing to Manage, How Viventium Brings Insight to Property Management. A couple of administrative things before we get started. You'll notice on your toolbar there's a questions feature, and I really want to encourage you to use it because I will keep my eye on the question bar as we go along. If I can answer your questions as we go along, I will, and if not, we'll try to leave some time at the end of my presentation on the compliance side for a question-answer session at the end. Following my presentation, we're actually going to have a software tour where we're going to go hands-on into Viventium, and Mia Saric, FPC, is going to lead that, and you'll be able to take a look at the software and at the solutions that we're going to be discussing at this point from the more theoretical compliance side. You'll be able to see how this actually works for you and how it happens inside the Viventium software product. This session is being recorded. The compliance session, the compliance information will be available and archived on our webinars site under viventium.com. And there you have two attachments, two handouts attached to your webinar today. One are the first one of the slides from today's presentation in PDF format. So if anybody would like to have that, it's there. And the second is some marketing information about Viventium, which I think is pretty exciting to see. So with no further ado, let's get started and learn more about managing to manage. We're going to be looking at 5 areas that are of a special impact to the property management industry, to all of you today. The first one is the WOTC, or WOTC, the Work Opportunity Tax Credit. Now really that's not specific to real estate management or to property management. The reason, though, that we generally highlight it is because very often management companies will be managing buildings in large cities, perhaps even in inner cities, and some of the employees, whether it's the resident supers in the building or other candidates, may be especially there may be a especially high percentage that are actually targeted groups for whom WOTC can be of benefit to you. So for those of you who are not as familiar with it, it definitely pays to get familiar with it and how Viventium can help you with it. The second is going to be talking about cost centers, or what we call multi-level cost distributions, and why that's especially a salient point for those who are managing multiple buildings and at the same time distributing payroll expenses over multiple areas. The Jabberwock, for those of you who are Alice in Wonderland fans, the Jabberwock of ACA, the Affordable Care Act, is what we call ALEs, or aggregated groups. And there's a couple of rules there that are not as well known and that may be very important for you to know, especially if you're managing various buildings, all with different federal ID numbers. We're going to look at that. It's something to be aware of. And at the same time, this Jabberwock monster can actually save you money if you're aware of how to use aggregated groups to your benefit, specifically in terms of employment tax wage bases. And then the last feature we're going to be looking at is housing allowances, meaning when you grant your building managers, your resident managers, your superintendents, when you grant them a free unit, a free apartment, or a reduced rent apartment, how that can, number one, count toward the minimum wage that you need to pay them, and number two, how that can be a non-taxable fringe benefit which has beneficial tax consequences. So really a potpourri here of a lot of different topics. And like I said, you'll also be seeing how these all work inside software when we do the software tour in the later part of our session. This compliance part is going to be approximately a half hour, 35 minutes, followed by a question answer session, and then followed by the software tour. So let's go into the Work Opportunity Tax Credit. Now, the WOTC has gone through many different reincarnations and different types of existences. It was originally many groups, then it was limited to just veterans. After veterans, it went back to all the targeted groups that it was. So the current form of the Work Opportunity Tax Credit is that it includes a handful of targeted groups, not just veterans. We're going to be taking a look at what those targeted groups are. There is one exception, which probably doesn't apply to too many of our listeners today, and that is for nonprofit, for tax-exempt organizations, the only group that they can get WOTC for, the Work Opportunity Tax Credit for, is the veteran targeted group. But generally speaking, most for-profit businesses can get the WOTC credit for targeted groups. What is the WOTC credit? The WOTC credit is a dollar-for-dollar tax credit, which you, the employer, claim on your corporate tax return, whether you're filing an 1120 or something similar. And it's not a payroll credit. It doesn't show up on your 941 or your 940 or anything like that, although it is related, of course, to human capital management. The credit is a percent of a certain amount of wages that an employee who is WOTC eligible earns. So, for example, if you hire an eligible veteran, you are entitled, after he has to work at least 120 hours generally before you can start claiming WOTC. But once he's worked that 120 hours and he continues work for the company, you are entitled to claim as a credit a certain percentage of a certain amount of their wages. Now, it's up to a certain amount. Now, the reason I'm saying a certain percentage and certain amount is because it varies greatly depending on which targeted group they're in. The maximum credit you can get in the best case is $9,600, $9,600 per targeted employee. So if you have 3 WOTC eligible employees, you'll get 3 times the $9,600. It won't come off on your employment tax returns at all. It will come off after you calculate your tax, your corporate tax at the end of your fiscal year. You will deduct that dollar for dollar. You'll deduct the credit. It's as though you already paid that much in tax. The form that you use, and this is again something your corporate accountant will be able to advise you on, is called Federal Form 5884. It's a federal program, a federal credit program, and you'll be able to use that to reduce your corporate tax liability. So now, how does WOTC work? Well, first of all, you're allowed to make hiring decisions based on WOTC, which means if you have 2 candidates come in, you can give them a questionnaire that asks about their qualified WOTC status, and if they're a veteran, if they're getting certain federal programs, you can ask these questions to screen their WOTC eligibility. And if you hire somebody, you have 2 candidates in front of you equally qualified, and you hire one because they're WOTC eligible, they'll entitle you to a corporate tax credit. Can you be sued for discrimination if that was what you based your hiring decision on? And the answer is no. The Equal Employment Opportunity Commission has come out and said, no, it's okay. You can make hiring decisions based on WOTC eligibility. And I guess when you think about it, kind of the logic behind it is that this credit is applied across the board to the targeted groups. In other words, if you're in a targeted group, then you're WOTC eligible. They've already said that. So the fact that you're picking someone because they're WOTC eligible is an objective characteristic. It doesn't mean because they have red hair or green nails or anything like that. So whatever the logic behind it is, you are allowed to make hiring decisions based on WOTC. In order to get the credit, after you have the, to make sure that you can get it for this employee, once you've identified that they're eligible, the employee actually has to go and within 28 days of their employment has to bring you a state workforce form called Form 8850, and that is the state workforce agency in whichever state you are, will certify that they indeed are one of the targeted groups for WOTC credit. So now let's see what these targeted groups are. First of all, anybody who's on an SNAP program, that's a program receiving food stamps, veterans with certain characteristics, certain qualifications, those who live in certain disadvantaged or low-income areas, which is again why I sometimes underscore this for real estate companies, I guess especially those dealing with buildings in inner cities, so you're more likely to have employees coming from there. People collecting what they call TANF, that's Temporary Assistance for Needy Families, again a federal assistance program. Certain categories of youth employees, certain ex-felons who have been released from their correctional facilities and are now going to work within a certain amount of time. Certain people on long-term unemployment, classified as been unemployed for a long time, and you give them the opportunity to start again, to renew their lives, to pick themselves up, you're entitled to a credit. And also those receiving SSI payments, Supplemental Security Assistance payments. The common denominator, if you notice, with most of these are people who, for one reason or another, the social policy of the country says we want to help them. We want to help them get jobs. They've been, down and out too long. Or in case of veterans, they've served their country faithfully. We want to give them an extra boost up to get a job. So it kind of would be defeating the purpose to say you can't hire someone just because of WOTC. WOTC is there to be, indeed, a hiring incentive. We're trying to get employers to hire these people, so we have to let them make decisions based on WOTC. And so you can do that. You can, screen them and you can track them. Now, what can Viventium do for you to help you claim your WOTC credit? Any client who's using Viventium's talent acquisition service, that's like the onboarding service, automatically gets free WOTC tracking. And coming soon, probably within about 4 weeks or so, WOTC tracking will be available free to all Viventium clients. That's the tracking service. At the point that you get someone that you want to go and apply for a WOTC credit for, then we have a fee-based processing where we, assemble all the information, submit all the forms, we do the processing for you. And if for any reason at all you are not deemed eligible by the government for the WOTC credit, there is a guaranteed refund of that processing fee. So you really have nothing to lose, and you stand to gain up to $9,600 in a tax credit per WOTC employee. So it's a great, it's really a great feature to be aware of, a great feature to take advantage of. The next point I'd like to point out, which I think is very interesting to most real estate management companies, I know for our existing clients it's very useful, are our multi-level cost distribution cost centers. Now, what's a cost center? The most common kind of cost center that we're used to thinking about is a department. Right? We divide up into maintenance and into administrative and into delivery and into production, whatever the industry is. You divide up your company into departments, and that's really a cost center. And you can organize your payroll reports, and you can see what was my payroll expense, what was my payroll tax expense, what was my unemployment expense. You can organize yourself by department. However, if you're billing owners, let's say you have clients and you're billing them for multiple building services, let's say for the payroll spent on electricity and the payroll spent on plumbing and the payroll spent on boiler maintenance and the payroll spent on painting services, painting extermination, you're billing them and you're classifying it by services. That's great. So you can have a department. But what if you're also billing them by building? So you want to be able to show for this building, let's say for building number 5, how much did all the maintenance cost? And then you want to also, on the flip side, be able to say how much was all the electrical work in all the buildings, one specific kind of maintenance. In other words, you want to be able to toggle back and forth. I want to see all maintenance in this building, or I want to see all electricity for all buildings. So which way do you set up your departments? Do you set it up by building, or do you set it up by electric, plumbing, gas? How do you do this? How do you go back and forth and toggle these reports? The answer is you do both. Because with Viventium, you can have an unlimited number of cost centers. In this case, you would need two. One cost center would be building. The second cost center would be type of service, electric, plumbing, whatever. And then you can create the most gorgeous analytics with this. And the truth is, when Mia does the software tour with you a little bit later in today's presentation, you're going to get a chance to see how this works hands-on. But you can, at that point, at the click of a button, just create a report. And if for your clients or for yourselves, you'll be able to see all this information. You'll be able to show a total of specific services for all buildings. At the same time, you'll be able to show all services for specific building, or let's say you want to pick out just building 1, 3, and 5 and see electricity and gas, or the amount spent in payroll, at least we're talking about here, on electricity and gas for these three buildings. With Viventium's cost centers, you can do this, and this is what we call insight. Viventium's analytics provide the insight that you need to run your business in the optimum way, and our CSRs, our client services reps, are well trained to help you do this. We will show you how to build reports, how to do a query, how to get the information you need at the tip of your fingers. And you're going to see this in a little while. Now, we go through the looking glass into Alice in Wonderland and the Jabberwock, my son. Beware the Jabberwock. When you have multiple buildings, I'm going to look at this from an ACA perspective. You might say to yourself, well, we have only one superintendent in each federal ID number, and we may have 100 buildings, but we're certainly not subject to ACA, because ACA you have to have 50 or more, and we only have one. Is that right? And the answer is no, that's wrong. That's not the way ACA works, but Viventium can help. So we have something in ACA called common ownership, or it's also called a control group. And the ACA legislation has created something called an ALE, an applicable large employer. ALE is applicable large employer. An applicable large employer means a group of employers or different federal ID numbers that meet the IRS Section 414 rules, meaning either it's parent subsidy, brother and sister, some combination of the above. It could be a common owner. It could be a group of shareholders that each have a certain percentage of interest in these companies, or some type of nexus where you might have a chain where one shareholder has 50, 70% interest in two buildings, and then another shareholder might have a smaller percent in those buildings and a bigger percent in other buildings. And there's all kinds of laws and regulations about what can link up all of these companies together when you have multiple shareholders sharing various percentages of shares. Now, Viventium will be the last to tell you what to do with this. In other words, we will be the first to tell you you need legal counsel to see where your ALE status is. Once you know what we're not a legal firm, we're not attorneys, I'm not here to give you legal information per se. However, once you know that you are a controlled group, that you are an ALE, then Viventium gives you the tools you need to be in compliance with ACA. And what does this require? What does this mean if you are part of a controlled group? Well, if every employer in that controlled group has less than 50 employees, but together the entire controlled group is more than 50 employees, then each and every employer is ACA subject, which means each and every employer has to do ACA filings. That means if you have a building with one super, but it's linked through a common ownership or a control group to enough other buildings so that you reach 50, that you reach the threshold, then even those buildings with one employee have to do the year-end 1094C and 1095C filings, and they have to report about their insurance offerings. Now, the trick here is that even though the groups are combined for determining whether or not you're subject to ACA, they're not combined for penalties. And so far, nobody's asked any questions, but after this one, I bet you will, because this gets a little tricky. We're going to work through an example. The penalties go by federal ID number separately. So let's take an example and see how this can work. Let's see how this works. Here we have Daddy Warbucks. Here he is. Let's have some fun with this, right? Daddy Warbucks. Oh, and by the way, I didn't tell you there was going to be a test here, right? So I'm going to actually run a poll after this example, and we're going to take a poll of how well, you can test yourselves how well you've mastered the information. Daddy Warbucks is a CEO of Tomorrow Management. He owns 55 buildings, or actually Tomorrow Management owns 55 buildings, 25 in New York and 30 in New Jersey. Does that make any difference for ACA? I hope you're all shaking your heads no. It makes absolutely no difference if they're in different states. Same thing, 55 buildings. Each building has its own federal ID number, its own federal employer identification number, FEIN. Now, each building employs a full-time employee, which means at least 30 hours per week, the following. Number 1, a superintendent. Number 2, a handyman. Number 3, a plumber. Number 4, an electrician. And each building also has an independent contractor, number 5, for extermination. Okay. Is that independent contractor counted for ACA purposes? Again, I hope you're all shaking your head no. Independent contractors, you don't have to offer them insurance. You don't have to file a 1095-C for them. So what we're looking at is 4 employees, 4 full-time employees per each of these 55 buildings. And none of the buildings offer insurance. Now, the management company, Tomorrow, they themselves have 60 full-time employees, and they don't offer any insurance. Those are our facts. Now, based on what I've said up until now, let's see if you can figure this out. Which of the following is true? Option number A. Only Tomorrow Management has to file ACA returns. B. Only Tomorrow may have liability for the sledgehammer penalty. That's about over $2,000 by now, times 30 employees. Interesting where that number 30 is coming from. C. Any one of the buildings could be potentially liable for a penalty of $2,000 times 280. That's the 4 employees in each of the 55 buildings plus the 60 employees of Tomorrow. Or perhaps any one of the buildings could be potentially liable for a penalty of $2,000 times 4, times its own 4 employees. Okay, so let's launch a poll now with this very question, and we'll see how well everyone can do on this. Okay. There you have it. Is only Tomorrow Management subject to ACA filings? Is only Tomorrow Management potentially liable to the penalty? Or is each building potentially liable? And if so, is it the 2,000 times the full 280? Or is it the 2,000 times only the 4 for each building? Okay, and we have about a quarter of our participants today, about a third of our participants today have voted. And we'll give it about another 15 seconds to get a little bit more participation. Go ahead. We're not giving out any grades. And just do your best to identify which is the correct answer here. And in another few seconds, I'm going to close the poll and share the results with you. Okay, anybody else want to cast their vote in before we close up? Okay, great. We have about 50% participation. Okay, and now we are going to close the poll and I'd like to share the results with you. So, as you see, we have a tie here. And then a winner vote. Now we're going to hear what's the correct answer. About 25% of you have said that only Tomorrow Management is actually going to be subject to ACA filing. Another 25% said that only Tomorrow is going to have some potential. It depends if the employees go out and get insurance on the marketplace and get credits, get insurance subsidies, but they have potential liability for 2,000 times 30. That's, again, where'd that number come from? And about half of you, 50%, have said that each building may have a penalty for $2,000 times its 4 employees. Okay, so now let's go back and take a look again at the rule over here. Okay, groups are combined for ALE determination, not for penalties. That means that answer number 1 is definitely wrong. it can't be that only tomorrow is subject to ACA filing. Why not? Because all of these 55 buildings plus tomorrow management are all part of an ALE. If you are a member of an ALE, you have to give a 1095-C at the end of the year to each of your full-time employees. Even though they only have 4 employees, if they're full-timers, they have to give them a 1095-C and file a 1094-C. So answer number 1 is not correct. And let's look at the last answer. Each building is potentially liable for $2,000 times 4. Well, the penalties are determined EIN by EIN, federal ID number by federal ID number. So let's take a typical building. It has 4 employees. If it has only 4 employees, there's no penalty liability because the first 30 employees are exempt from penalty. Even if there would be that sledgehammer penalty, remember in ACA, it's not an ACA webinar, but there's a provision that the first 30 full-timers you don't get penalized for. So there can't be any penalty there. And therefore, the correct answer, and there certainly can't be any penalty for all 280 because each one is judged separately for penalty assessment. The correct answer is what 25% of you said, and that is only tomorrow could be potentially liable for that $2,000 penalty. And it's $2,000 times only 30 employees. Thank you to those of you who pointed out that you weren't seeing the screen. We were just back here on this slide where we had the rule groups are combined for ALE determination. So again, since the first 30 are exempt from ACA penalties, and tomorrow management, here in our example, had 60 employees, so the $2,000 penalty is only levied potentially on at most 30 employees. So again, each EIN has to file for ACA, and Viventium will do the filing for you. However, the penalty exposure is only on the large company and not on those small companies because they're below the threshold of the number of employees to trigger a penalty. Now, what Mia is going to do when you do the software tour very soon is actually show you in Viventium how do you link companies together. How do you indicate that they are all part of this ALE, this applicable large employer? And that would trigger, of course, the necessary compliance. Viventium would then do the filings for you as part of our ACA service. Okay, so that's the bad part of being part of a controlled group, the monster part. But this same Jabberwock, this same monster, can actually work in your favor, because if you are a combined group, then you are allowed to count wage bases only once and not twice for FICA, FUTA, and SUTA if you have employees working in more than one FEIN. Okay, that's a mouthful that I just said. Let's take it, and Viventium will do this for you. If you tell us that you're a combined group, we will be able to combine your wage bases for tax calculations. Again, what Viventium provides is insight, and of course the HCM expertise, but not legal guidance. We won't make the determinations for you. That's between you and your legal counsel. Once you come to us and say, we are a combined group, please combine our wage bases, we will do it for you. So let's take an example. Mr. Thumb is a painter for 1254 Main Street Operating Company, and he's also an electrician for 5421 Kings Highway Associates. He's an employee for both of these real estate companies. There are different federal ID numbers. There are different state unemployment ID numbers. But both companies, 1254 Main and 5421 Kings Highway, both companies are owned by the same 2 shareholders. That means they're a combined group. And in this example, you are allowed to combine Tom's wage base. So let's say Tom earns $7,000 in 1254 Main, and in the year he earns $8,000 in the second building. How much do you have to pay FUTA tax on? You know, FUTA you only have to pay on the first $7,000 of an employee's earning. And in this case, you might say, well, there are 2 different federal ID numbers, 2 different filings. So he's going to have to pay $7,000 there, and then the company is going to have to pay on the $8,000 also. And the answer is no. This works to your benefit if you're a combined group. The total FUTA taxable wage for Tom for the year is only $7,000. He maxes out. And it's not $15,000, so the companies, the group's combined FUTA tax will only be $420. So there's where a combined group actually works to your benefit and helps you save money. Okay, The last thing we're going to look at before we actually launch our software tour is what we call Section 3M of the Fair Labor Standards Act, the FLSA, and that is a provision that if you're giving your employee a place to live, that has a value to it. And that can be counted against the minimum wage that you have to pay. Now, there's certain specific requirements. We're going to go through them, but you can offset that against his minimum wage. So let's say you have a resident manager. We'll call him a superintendent. And you're giving him a rental unit, primarily for his benefit to live in. You're allowed to take the reasonable value, the market value of that rental unit. You're also allowed to include any fuel, electricity, water, gas that you pay for, assuming that they're accepting it without coercion. And it's been deemed that superintendents accept these things without coercions in buildings. You can then take the value of that dwelling, of that housing that you're giving the employee, and count it as a credit against your federal minimum wage payments to the employee. Now, you have to keep records, and Viventium makes it easy for you to do this. You have to keep the utility bills, perhaps a record of what other similar apartments are being rented out for, and there's a place to upload that on the employee level so that if it's ever called into question under any type of a labor audit, you can just pull it out and say, here's all the bills, it's right here in the payroll system. And as a matter of fact, Viventium will also show the credit on the stub. Anytime you take a credit against minimum wage, you have to show it on the pay stub. You can't just tell the employee, well, just trust us, we're paying you minimum wage. So Viventium complies with that law. We will show the credit. We will label it as housing minimum wage credit or any other label you'd like us to put on it, but it will show on the employee's pay stub. And we can give you guidance, again, to go back to your CPA or to your attorney, your legal counsel, but it's generally been deemed that if the employee has had a home and he leaves his residence to live where the employer needs him to leave, then it's probably, it's probably not eligible for the credit because that's not so much primarily for the employee's benefit. He had a home already, and then they said, okay, you have to come live here, for the time being to do this job. So the value will be exempt from tax. We'll see that in a minute, but it won't be eligible for the minimum wage credit. And this nuance is something that Viventium supports. And I'd like to do an example with you. So we have Donald, who is a super for 1600 Pennsylvania Avenue Associates. And he's given a one-bedroom apartment, and he lives rent-free in it in exchange for a 40-hour work week. Okay, so he's living in the building and working 40 hours in that building. The reasonable value of the apartment is $2,000 per month. How much additional wage does 1600 Pennsylvania have to pay Donald to meet its minimum wage requirements, at least for the federal purposes? You don't have to touch a calculator. You don't have to pull out an Excel sheet. Once you're set up for this feature, Viventium does it for you. What do? We take like this. $2,000 is the reasonable value of the apartment per month. Multiply that by 12 months and divide that by 52. What's the weekly value of the apartment? 461. Why do I have to translate it to a value per week? Because minimum wage works based on work week. So I have to bring everything to the weekly level. Now, 461 and these dollars a week he's working 40 hours a week. That means he's getting an effective wage of $11.53. And you have satisfied federal minimum wage with no additional wage necessary, theoretically, because state laws and state credits may vary. You may not be able in some states to take the entire housing value against minimum wage. There may be a limit, and there may be also a limit, there may be also a different minimum wage, as you know. For example, in New York City, for a large employer, minimum wage is $11, not $7.25 like for federal purposes. But at least this is the theory behind how a minimum wage credit works. Now, I made a reference before that even if something is not eligible for a minimum wage credit, it may be a non-taxable fringe benefit. That's called lodging. If you give an employee lodging on your own business premises, which in this case is your building, it's furnished for the convenience of you, the employer, so that they should be there to do work and, in the middle of the night if there's a pipe burst or whatever it is, they're there. And the employee accepts it as a condition of employment. You're only going to hire this super if he's going to live on premises. It's a condition of employment. Then the value of the lodging is non-taxable. So here's an example. Rosie's a plumber for 1315 Avenue M Associates. As a condition of her employment, to make it easier for her to fix leaks, to be there to fix them quickly, she has to live in the building, and they give her a free unit in the building provided by the employer with a reasonable value of $950 per month. And then in addition, they also pay Rosie a cash salary of $500 per week. How much is taxable for federal income tax, federal withholding, FICA, and FUTA? Only the $500. The full $950 is exempt. It used to be exempt only for federal purposes, withholding income tax, and it was taxable for FICA and FUTA, and then a court decision came along and said, no, it has to be treated the same for federal, FICA, and FUTA purposes. This is a benefit to both the employee, because it doesn't have to pay FICA on it, and the employer, because the employer doesn't have to pay the employer share of FICA, nor does he have to pay the FUTA tax. Again, state treatments may vary. This is on the federal level. Before I turn over the reins to Mia for our software tour, does anybody have any questions? Please feel free to use your question toolbar.